we're going to be covering all the FX majors, including the dollar index, highlighting what chart formations we're seeing this week, also our bespoke support and resistance levels, and also highlighting basic chart formations and what we're looking to target for the week 19th of November 2018. So we're starting off with the dollar index. We mentioned in last week's report that we had a Fibonacci confluence area. We've basically seen a 5-wave move to the downside on this larger time frame, and then a 5-wave move to the upside. We believe we've now completed this bullish run. We had a Fibonacci confluence area. It was 97.39, 97.86. We made a high of 97.69. We've now got a reversal formation on the dollar index. We've got a bearish engulfing candle on the weekly chart. Could also be seen as an inverted hammer, which is often seen at the top of a trend. There's another one here. Okay, so our bias for the dollar has flipped to the downside. If we go to a shorter time frame, and this is the daily chart, we can see quite a decent and aggressive move lower, especially on Friday. We might see a bounce earlier on in the week. 96.14 is trendline support. 96.16 is a 161.8% extension level of this decline. But like I was saying, any rallies really should be sold into, and we're looking for a channel break next week. We've also got some bearish divergence on this time frame. So basically the chart has made a higher high. The oscillator, in this case the RSI, the relative strength index, has made a lower high, often an indication that the trend is exhausted. So we're going to flip that bias onto the FX majors and basically discuss what we're looking at for the week ahead. Let's go to this time frame first. Reverse of what we've seen in the dollar index. We've actually got a bullish engulfing candle or a hammer base on this chart. We can see a 5-wave move to the downside. The long-term picture, and we're talking months, not weeks here, is still for a move lower with the target level being 105.64, which is the start of this wedge breakout. But we're now looking for a choppy free wave correction to the upside. If we go to the daily chart, here we can see that we've got a channel resistance, but we haven't really got any bespoke resistance until this level, which is 115.17. We could stall there, and what I've highlighted here is the possibility of a reverse head and shoulders. So basically the left shoulder coming down to form the head, and then an impulse move to the upside, perhaps stalling at our bespoke resistance, and then coming down and hitting this reverse trendline support to actually form a right shoulder. And for a medium term call, we really would look to buy on the potential correction or the dip lower before we look to take extended longs to the upside. If we go to this time frame, the 4-hour chart, Monday we've got some resistance. It's going to line up pretty well with that trendline resistance at 114.36, which is a 161.8% extension. I've highlighted our bespoke resistance, and then we've got a 261.8% extension up here at 115.72. So as far as that Elliott wave is concerned, wave 1, wave 2, potentially 3 and 4, and then up in 5, and I'm wondering whether or not we'll get a stalling, like I said, at this resistance level, and have a short 5th wave up close to a previous swing high. Sterling dollar, an AB equals CD formation target was hit, or very close to an ABCD formation target was hit on Thursday's aggressive sell-off. We've now got an inside bar. It does highlight an amount of indecision, but it's only because we've had such an aggressive move lower. But when we take that dollar bias into consideration, we're still looking for an upside move in cable next week. If we go to the shorter time frame, And we've got our bespoke resistance at 131.27, and it's also the 261.8% extension level. We do need to see a break of Friday's high to confirm that projection higher, but we are looking for dips to be bought into early next week. Dollar Swiss. Again, we'll go to the weekly chart first. We've got a trend of higher highs. That's located at 100.87. Similar to the dollar index, we've got an inverted hammer as price has moved to the downside. We've also got bearish divergence. If we go to the daily chart, we can see that we've broken this trend of higher lows. Reverse trendline resistance is now located at 100.52. The strength and scope of the sell-off on Friday does beg the question whether or not we will see any sort of corrective move early on next week. We've got our bespoke support located at 99.38, and that's close to a previous swing low back from the 7th of November. If we go to a shorter time frame again, and this is just highlighting two bespoke support levels actually. 99.72 is near the 161.8% extension level at 99.78. So there's a scope for a mild bounce again on early next week, probably on Monday. But we've then got our bespoke support here at 99.37. Similar to euro dollar, but obviously reverse, is the scope for a short fifth wave, if you like, early on next week. If that happens, then there is scope for a bounce to the upside and potentially have a left shoulder, head, this forming the neckline, and then moving higher to a right shoulder before we continue with this medium-term sell-off. So at the moment we're bearish. We're going to obviously make notes of all three of these levels at the beginning of next week to see what price action brings. It should be noted actually that on our signals, dollar Swiss has triggered quite an aggressive medium-term sell-off, so we could well move all the way down here to 98.85, I believe, before we see any sort of corrective rally next week. Dollar yen, and this has got to be probably the preferred trade for next week if we're going to have a trade of the week, and that's basically because we've got our bespoke support lining up with all of the Fibonacci extension levels and also the target level for this wedge breakout. So the wedge breakout, we had a retest. The target level is here, which is the start of the wedge, which is 111.37. We've got 261.8% extension level at 111.26. We've got our bespoke support at 111.29. So we've got a lovely confluence area down here to target. And we've also got a bespoke support level at 112.35, which is lining up with this 161.8% extension. So again, early on in the week, expecting the dollar move to continue, and then a corrective bounce, and then a move down potentially in the fifth wave. So again, 1, 2, 3, 4, 5 is what we're projecting for next week. Dollar CAD. Wedge breakout. Didn't quite get to the reverse trendline resistance at 133.04. We've seen an inverted hammer. It's not a bearish engulfing. It does offer a mild downside bias. We really need to keep an eye on oil as well next week to see if this projection is going to work out and whether or not we're going to play down to our support levels. We've got a bespoke support at 131 the figure, and then at 130.63, and it's in between this 261.8% and the 423.6% extension level. Now, commodity currencies or pairs have a tendency to move to this Fibonacci. At the moment, we're bearish, and we will be looking to sell into rallies. Not as strong a signal as the other dollar majors, but saying that, we are still bearish in dollar CAD. Aussie dollar, now we've broken that 261.8% extension level. Again, it's a commodity pair, so there's the scope for a move up to here, 423.6. Our bespoke support, 74.23, 74.86. early on next week, we've got support at 72.71. Again, the call at the moment has got to be to buy into dips for looking basically at further dollar weakness and Aussie dollar strength. Euro sterling, obviously extremely volatile with the Brexit news. Let's have a look at this time frame first. Actually, this is the monthly chart. We've got another 13 days of this month to play out. So we're just contemplating whether or not we'll hold this breakout. It's going to have to move back down lower below 88.10 to not produce a false breakout. If it does, then there's scope for a higher correction. So in other words, this would be wave AB, this would be BC, and then CD to the upside. So we're just going to be playing short-term trades in euro sterling next week. If we go to this time frame, this this channel breakout is still holding. We've got 89.44 as reverse trendline resistance. It has been tested once. It's unlikely that the second test will hold. So again, we need to really be monitoring this quite carefully. The shorter time frame shows that impulse move to the upside. We overextended the 161.8% extension. I believe that's wave 3 and 4. We've got bespoke resistance located at 89.52, which is an overextension of the 261.8% level, which is 89.22. If we look over here, sort of this area is likely to attract at least some profit taking, I believe, at the beginning of next week. But the medium-term bias or the medium-term outlook, as far as we're concerned, is definitely mixed in this cross currency. Euro yen, and I'm only going to show one time frame in this cross because it really is mixed, and I believe we're just going to stay within this channel formation at least for the short term. We tried to buy dips on Friday, quite late on Friday at 128.09. I think we got down to, what was the low? Well, 128.12. We missed our trigger level. We did get a reaction higher between the 50 and 61.8% pullback levels. I now think we're in a channel formation. The reason I like this really going into next week is that the channel support, which is at 127.90, is close to our bespoke support at 128.10. And more importantly, if this is a correction to the upside, then 129.48 is very close to our channel top, which is at 129.46. And obviously, remember, this is a 2-hour chart. So as the price moves higher, this is going to move up and could potentially line up with this Fibonacci confluence, this bespoke resistance level, and make a confluence area, which would be quite attractive to selling into rallies. So the immediate bias would be to buy dips, but only up to around 129.50, where we would reevaluate euro yen for next week. Okay, I hope that's given you some ideas of what we're seeing. Good luck with your trading, and we look forward to speaking to you again next week. Many thanks.